Hello and welcome to this bite-sized training session, which is hosted by Farrar's Building. My name's Michael Dougherty. I'm going to spend the next 15 minutes or so discussing the basic principles of valuing a claim. The talk's suitable for claimant or defendant lawyers. The objectives of those acting for the respective parties may well differ, but will use the same principles. And at all times, this will necessarily be an approximation, and managing a client will be an important part of your role. The talk is principally aimed at trainee and new practitioners. I don't intend in this talk to deal with cases in the context of the whiplash reforms and the new small claims process at CPR 27B. The talk will look at heads of damage in a fast-track claim and also quantum of loss more commonly associated with larger value claims. But as far as possible, as you'll see, I will set out to separate those. In terms, heads of losses can be usefully separated in practice to special damages, being financial losses incurred from accident through to trial, ones which are capable of precise calculation, and to general damages comprising first an award for pain, suffering and loss of amenity from injury, and secondly future losses, loss of earnings, future treatment and care costs. And I flag care to be clear as to terminology in discussions, particularly with the other side, as those speaking to future losses are sometimes termed as special damages for future loss. It's always of assistance to contextualise by example, and today's example is as on the screen there. We will use Bob, a self-employed builder who suffers serious injuries and losses running into the future, prior to which we'll look at his partner Wendy, who has a less serious injury and vehicle-related losses. I'll deal first then with Wendy's claim, which is for damages for a broken wrist and her vehicle and other related accident damages and losses. First, her vehicle was written off, albeit in many circumstances the vehicle will be repairable and the recoverable damage will be the reasonable cost of repairs. In Wendy's case, the vehicle was written off because it cost more to repair than its value prior to the accident, and so the recovery is of the pre-accident value of the vehicle less any salvage value. While her car is assessed and until she gets a replacement, she hires a replacement vehicle on credit hire for 30 days. The starting point here is 30 days at a higher rate of £100, so a claim for £3,000. The defendant will, as you will I'm sure be aware, challenge that principally on the basis of need, period, and of rates by evidence. And I'd commend you to some webinars on the Farrar's Building website for more detail on those matters. Wendy also has loss of net earnings, and it's important to be clear, net earnings after tax and deductions. She had a month off work. In a claim such as this, one may need to look at the base salary plus commissions, overtime, regular bonuses and other matters, and may also need to account for payments from the employer in the period of absence. If Wendy was self-employed, we provide evidence of her pre-accident income for a period or published accounts. On these facts, she earns £500 a week. She received no payments, and so she has £2,000 of lost earnings. Wendy may claim for clothing damaged in the accident. That would be similar to the vehicle based on the pre-accident value. In this instance, a dress bought for £100. The defendant may argue that the value is now worth less, but remember the principles of collecting evidence as best as possible, but it's entirely possible there'd be no receipts for such a claim. Physiotherapy to assist in the recovery from injury. A defendant may engage with this and may provide that treatment on the premise that the prompt treatment can assist in reducing the period of injury and the damages on that. There may also be prescriptions for painkillers, and these may form part of the arguments in terms of PSLA damages for the injury later. Were the tablets prescribed? Were they taken? And so on. There may be treatment aids, so devices or similar used to assist in the recovery. For example, in this case, there may be a wrist brace with a broken wrist. Travel expenses are there to account for travel to appointments and so on. Travel to see the medical expert for assessment for purpose of the litigation, I suggest is more properly a cost, but is commonly also contained in here. And here it's claimed at 45p a mile, in line with the HMRC allowable rate for business purposes. Miscellaneous expenses, often pleaded, often unproven, or pleaded generically as matters speaking to the costs of the litigation, commonly conceded at trial and are very often a minor sum such as this. In my view, you ought to ask yourself, can you characterise it and can you prove it? You wouldn't plead miscellaneous injury or miscellaneous vehicle damage, but that often appears in a claim. Care may also incorporate DIY and services around the home. This is essentially help in the home, which on these facts, Wendy was assisted by her mother, Wendy Senior, for 4 weeks at 4 hours a day, then for 8 weeks at 2 hours a day. In principle, commercial costs of such care can be recovered if it's reasonably procured. More commonly, the claimant claims for recovery of care provided on what's essentially a gratuitous basis. So this being care over and above what would ordinarily be provided on Wendy's facts, perhaps childcare assistance, cooking, cleaning in the home. So Wendy Senior comes round to do those things. It's important to understand it is Wendy Junior, our claimant, who makes the claim on the basis of her need for the services, and those damages are held on trust by Wendy Junior, our claimant, for Wendy Senior, the care provider. On a fact-specific basis, it's possible that if Wendy Senior had given up work to undertake such care, her loss of earnings could be claimed. Here, we use a helpfully more simple situation, and more commonly this is the case. Reference is made to the professional costs of care, generally by reference to the National Joint Council for Local Government Services table at spinal point 8, and that represents the earnings of care home workers, with allowances possible for the location and the time of day or night. You'll see on the calculation here, we can alternatively use an aggregate rate across the piece for all the care, and I adopt that for simplicity here. That is typically discounted by between 20 and 30% to reflect the gratuitous nature, and that's to say there's no tax, national insurance or commercial profit element contained within this, and so the care value here to just over £2,000 is arrived at by the calculation there. Separately, general damages in this instance arise for pain, suffering and loss of amenity. I mentioned it's a broken wrist that Wendy has suffered. This engages questions of the extent of the pain, of the treatment, the current condition at the time of a medical examination, and a long-term prognosis for whether there's a full recovery, whether there are continuing or permanent consequences of the injury. I should also say if the injury were an aggravation or an exacerbation of something which pre-exists, the defendant would be liable for the extent of the aggravation. The Judicial College Guidelines, JCG, as referenced on the slide there, are just that. They are guideline ranges for awards. Wendy has a broken wrist, and in the Judicial College Guidelines 15th edition, Chapter 7H deals with wrist injuries, and to that extent, normally things will be uncontroversial. There are 3 example brackets I've produced on the slide there, which may be capable of application depending on the medical evidence and the written and oral evidence of Wendy, the claimant. In case specific factors will be capable of moving the award up or down brackets, and case specific may involve the particular impact on Wendy, may also engage matters such as whether this is her dominant hand and so on. It is also the case in square brackets there that we use quantum reports. Quantum reports are comparator cases. There's inevitably a degree of generalizing involved in the use of brackets in the guidelines, all the more so if we're dealing with multiple injuries. And so quantum reports provide examples of awards in similar circumstances. Couple of important observations. They generally show inflation for the present day value of the award made in the comparator, but important to check. And also note that comparators might involve awards at a contested trial, or they may reflect settlement sums which may have been reached subject to judicial approval with children or protected parties, or maybe settlements outside those structures. And so bearing in mind, there may be a range of reasons for an amount being arrived at, and matters are always fact specific. For present purposes, we allow the upper end of Chapter 7H, bracket F, £4,450. But remember, in all these instances, the claimant's advisor's role is to legitimately plead to the maximum value. The defendant's role is to challenge and reduce that. and some pragmatism is always called for by each in advising on the realistic value. So here the claimant may argue for a higher bracket than bracket F, but remain cognizant of the factors weighing against that, as well as for the claimant's contended valuation. So in principle, therefore, on a relatively simple claim such as Wendy's, where all losses have crystallised or they're capable of calculation with a degree of precision and finality, we can see that her claim is pleaded at just over £16,500. Now, before moving on to aspects of Bob's claim, which make his a little more complex, I pause just to deal here with the notion of handicap on the labour market, the asterisk next to loss of net earnings reflected at the bottom of the slide. And this is if, for example, Wendy could continue to work at the time of trial, but there's a real, not a speculative, risk of a loss of work at a later point. Smith and Manchester is a methodology, a principle by which a sum can be awarded to account for that. It's a matter outside the scope of today's bite-sized session in detail, but I pause to mention that there. I also, finally, don't complicate matters by creating some sort of counter-schedule slide against this pleaded claim, but it's entirely probable and possible that the defendant might say, for example, that the pre-accident value at the top there is admitted subject to liability, that the credit hire is challenged on a variety of grounds, entirely or in part, that the loss of earnings is accepted subject to evidence, but less any payments received, that miscellaneous expenses aren't recoverable, perhaps also that the care might be reduced in circumstances if Wendy had returned to work and hers was a caring role. And that might also be an argument if that were the case, as against reducing the PSLA award. She's gone back to work earlier, or the ongoing symptoms weren't quite so severe, or perhaps she stopped her physiotherapy halfway through. But that's Wendy's claim, which would be, as has been said at the top of each slide, allocated doubtless to the fast track. Bob's claim, more significant. He's been more significantly affected. Bob has a disabling spinal cord injury, for which his loss of amenity and his PSLA award and his losses up to trial would be calculated in very similar process to Wendy, although of greater value. But a number of more complex considerations arise from that and thereafter. The first head there is loss of congenial employment. That might be sustainable on the facts of this particular case. This is a mechanism by which to compensate the loss of enjoyment of the particular employment. It's something which is generally applicable to professions or roles that require a particular skill or craft. In Bob's case, he'll no longer be able to practice his particular skill of intricate carpentry, and the court may be persuaded to make an award to reflect the loss of that congeniality. A typical range for such a discrete award is between £5,000 and £10,000. We then have future loss of earnings. This comprises what Bob would have earned to the end of his prognosis period, or on these facts until he retired. He will not work again. It inevitably calls for a degree of speculation, and an example of an area of challenge by the defendant would be to suggest, perhaps, we can see there we say Bob is going to retire age 68. It may be said that someone in a heavy manual role like Bob would retire earlier than, for example, we soft-handed desk-based lawyers. The purpose of the award is to identify and arrive at a sum of money, which if it was given to Bob at the time of the trial, and which if he put it into a suitable investment vehicle, it would enable Bob to draw down his earnings, his £2,500 a month in net earnings, as against what you see on the slide there, as he would have done ordinarily by methods of payment each month, and for him to arrive at the end of his prognosis period or the end of his working days with precisely zero. And the ingredients to get us there are essentially a multiplicand and a multiplier. First, the multiplicand, that is the net annual sum of earnings but for the injury, or in different circumstances would be the gap between what would have been and what now is if other work is being done. For today's purposes, we prefer simplicity. We assume no residual earnings. £30,000 a year is the net loss. The multiplier is drawn from the period of future loss, and that is the period from the date of trial onwards. The multiplier That can be again for a term fixed or for the situation we adopt here, which is that Bob will never work again. And to arrive at the multiplier, we use the Ogden tables. They are currently in their 8th edition. They can be found in publications from, amongst others, for example, the Facts and Figures. And using the tables, which again can be a rather fuller and more detailed discussion than this bite-sized session allows for, but that involves consideration of factors including Bob's gender, retirement age, his age at trial, as shown on the slide. Briefly, Bob is 45 at the time of the trial. He's produced accounts with an average net income of £30,000, as we see. He'll notionally retire at age 68. Ogden Table 11 provides multipliers for loss of earnings to pension age 68. A discount rate will apply. That's factored into discount for early receipt of these funds, and that's currently set at 0.25%. So the appropriate multiplier in table 11 for Bob is 22.71. We then have to account for risks other than mortality, such as whether he would otherwise lose his job at some point and so on, to arrive at the effective multiplier for Bob. The operation of factors other than mortality is based upon subjective factors such as his education, whether he was disabled pre-accident, whether he was working at the time. On Bob's facts, we would use table A. He's currently self-employed, he did GCSEs, and we can apply a factor of 0.85. And bringing those two together by multiplication, we arrive at the appropriate effective multiplier of 19.30. We then take the £30,000 multiplied by the 19.30, and Bob's award for loss of earnings ought to be in the range of the sum shown on the slide. Bob will also need care going forward. He needs support and assistance from carers, and here on a future basis, as distinct from Wendy's claim for past care. He'll need that for the rest of his life, and we obtain his multiplier for life from table 1 for males, table 2 operates for females, and so his whole life multiplier from trial is 41.85. Pausing briefly, one can use interpolation to account for part years, and that is taking the midpoint between 45, 46, etc. Here we keep it very simple. The multiplier here is not subject to discount for factors other than mortality, as distinct from loss of earnings. So we take the 15,000 multiplied by the 41.85, provides the future care figure. Future medical aids, as I term here, allows for replaceable aids, such as Bob's going to need a power chair every 5 years. The calculation takes the capital cost of the item, it divides that over the number of years use, and before each replacement will be needed, and that then arrives at an annualised cost of providing the benefit of that aid or equipment. So as we can see there, the power chair has an annualised cost of £2,000. The multiplier of 41.85 is again drawn from table 1. The asterisk there just reminds me to mention that there are other ways of performing this calculation. The figures don't differ significantly. This is the simpler method on the facts. The power chair, £2,000 a year, the stair lift there, £500 a year, the multiplicand, therefore 2,500, the multiplier of 41.85. Finally, for substantial purposes, there are cases where the claimant needs some adaptation to the property. If it's adaptation to the property, there's a distinction to be drawn between adaptations that do add value to the property, for which account must be made, or adaptations which do not add value to the property, in which case recoverable in full. In Bob's case, he needs to move to a different property. He needs a single floor, a bungalow, and greater accessibility, for example. The method of calculating the appropriate award follows the decision of the Court of Appeal in Swift and Carpenter last year. The full reasoning and principles therein are a matter for another much longer talk, but the principle is that there is a methodology to avoid a windfall, an approach that's based upon the capital value needed to fund the greater sized or more expensive property, less the market value of what's called the reversionary interest in that property at the assumed date of Bob's death. Again, it's a sufficiently complex area to lie largely outside the territory of a bite-size intro, but the calculation in simple terms is this. First, identify the value of the current property, as we see on the slide there. Second, identify a suitable alternative property and the value. And thirdly, calculate the difference between those two values. The fourth aspect is carrying forward that life expectancy of which we are already aware. And thereafter, we multiply the £250,000 differential by 1.05 to the minus power of the multiplier. The 1.05 is to factor an assumption of a 5% return on investment for the notional annual return to be expected by the notional purchaser of that reversionary interest in the property, which is essentially the extra necessary, which would be an overcompensation once the need during the life period is concluded. And again, we multiply 1.05 to the power of minus the multiplicand. Once we do so, we deduct that sum from the differential value, and the result is the value of the additional property claim for damages purposes. Again, Bob's total on the slide there doesn't include his past losses, but again, they fall to be contemplated by a broadly similar manner as Wendy's claim. That then has been a whistle-stop tour of some of the ways in which some of the most common heads of damage are calculated. I briefly, before finishing, touch on some other points that aren't dealt with previously that might be relevant in matters you deal with. Provisional damages, in terms, this is an exception to the general rule that settlement is final. It's a means by which to be able to account for a chance, one which is below 50% and generally reasonably low, that the chance of an outcome that if it happens gives rise to a particular difficulty, which is for the claimant to be compensated now at the percentage probability, for example, 5% chance of £100,000 damage. If the matter comes to pass, the claimant is undercompensated by the 95%, £95,000. But if it does not, the defendant has overcompensated the claimant by £5,000. And the alternative provided by provisional damages is that the claimant is able to return to court in tightly defined circumstances if the eventuality comes to pass. Periodic payments is an alternative to the inevitable imprecision which arises from matters such as, for example, Bob dying earlier than accounted for, which would essentially be detrimental to the defendant who's compensated on account of a longer period, or alternatively, the money running out when Bob exceeds his anticipated life, which is essentially detrimental to Bob, at least in respect of damages, if not life. In such a case, the court can order that payments are made out to Bob on a periodic basis rather than the single lump sum approach that we calculated on. It's something the court must consider, but it's something the court will order if satisfied that those payments, particularly in future, are secure, which may be secured by the purchase of a lifetime annuity or some other measure. There are other matters such as whether Bob's life expectation had been reduced as a result of his injury. We account for that in the Ogden calculation simply by adding years to his age to bridge that gap. If Bob had been given a known life reduction period, i.e. he has merely 10 years to live, alternative tables exist to account for losses for a known period. Remember also, lost earnings may be slightly more complex than Bob's are. He might have wound down his business towards the age of 68, or another claimant may have a defined career path or trajectory or goals and would need to account for wage growth that would have occurred but for the injury. There can also be matters of loss of dependency in fatal cases, loss of pension and others. I would commend to you webinars on the Farrar's website that deal fully with those matters and others. I hope, therefore, that you found this session useful. Please do refer to the knowledge base section of our website for other bite-sized training sessions. And if your team are interested in more in-depth or personalised training, please do contact our marketing manager, who will be happy to discuss requirements in more detail. It only remains then to thank you for joining me and wish you all the very best.